Good afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you who are joining me here on the East Coast. It's just after 12 noon Eastern Time. I'll say good morning to those of you joining us from the Central Time Zones, the Mountain Time Zones, and the Pacific Time Zones as well. I also want to say good evening if any of you are joining us from across the pond there in parts of UK or parts of Europe as well. Welcome to today's presentation, how to properly lock in gains, smile through earnings. We've had a good market run over the past 15 to 16 days or so, and one of the conundrums that we face as investors, doesn't sound like it, but a real conundrum is what do we do when the stock is up? It can be just as perplexing as what to do if the stock is down, what to do if our stock is stagnating. And this doesn't apply to just stocks, it also applies to other positions, option strategies as well. Well, first let me introduce myself. Kurt is not going to be able to be with us today. Of course, many of you know me. My name is Mike Chupka. I'm the Director of Education here at Power Options and Radioactive Trading. I've been investing in options, trading options for the past 15 years, since about 2001. And I've been using the radioactive trading techniques with about 50 to 60% of my trading capital for the last 8 years or so. And why am I doing that? The reason why is that since I have been trading for 15 years, I did trade covered calls for an extended period of time and wasn't getting the returns that I was promised. Branched out into standard collars, which I still trade with a portion of my account, cash secured naked puts, which also didn't give me the reward that I felt was worthwhile for investing. I did do an extended period of trading credit spreads with a large portion of my account, but I found that the time that was needed to watch the trades and manage the trades just didn't match what I was willing to do, and it wasn't a successful outlay. A conversation I had with a gentleman the other day, we were talking about calendar spreads, calendar calls and calendar puts. For about a 7 to 8 month period, calendar spreads were the most successful option strategy I've ever traded in my personal account, both monetarily and percentage-wise. 4 months after that, calendar spreads resulted in the largest losses monetarily and percentage-wise of any option strategy I've ever traded. So I keep trading radioactively, and I have been for the past 8 years because it is the strategy that has shown me more consistent profits year over year opposed to the other strategies as well. Now, what is different about radioactive trading? At radioactive trading, we focus on controlling and limiting the risk on our position first, rather than potential for a high yield that carries unnecessary risk. Many of you might be investing in credit spreads, and you look at positions that have this great 80% or 85% probability, and you're looking at a good leveraged return of maybe 11% or so. Well, that means you might be generating 50 cents of credit against a 5-point spread. Looking to make 11%, but having a 10-to-1 risk-reward ratio. Even though you have an 80% theoretical probability on your spread, with that risk-reward setup, you're going to need to be right more than 90% of the time to profit long term. So it's not necessarily that the risk in a credit spread is bad. You know it up front. It's dialed in, of course. But the spread itself offers a 10-to-1 risk-reward ratio, which can hurt over time. So is radioactive trading, is the married put just stock insurance? Well, it is, but it's much more. Radioactive setup consists of buying a stock and buying a put combination at the same time. This ensures the stock, but we also purchased two assets. We can manipulate the put just like any other option to take advantage of changes in time value, intrinsic value, time frame as well, manipulate the time frame in and out based on our needs and what we're looking for. So it's not just about insuring the stock. You are purchasing another asset that you can use to manipulate the position, and we're going to look at that today. Now, this might not be important to many of you. It might be just a basic review and something you already know. But I did have a conversation, about a 35-minute phone conversation with a Power Options customer yesterday, and I was surprised at the concepts that this investor had regarding how excited he was to do covered calls. Because he said it simply, he heard about it from his buddy who was a real estate agent, and he said covered calls is just like renting out your house. The idea of renting out your stock and collecting a premium on a monthly basis, it's the same thing, only better because you have a smaller amount of capital in the stock than you might have in your house. You sit back, You collect the premium. Well, it sounds simple, easy, and profitable, but we all know the analogy is not that simple. If you rent out your house, you're going to have insurance on it for damage, for fire, for flood, for someone completely destroying the house as well. Across the street from me, a family just moved out of a house that they were renting, and I've seen workers at that house for about the past 8 days, and I actually went in to talk to them the other day, and I was just amazed how bad the floor was. Complete smell of cat urine and dog urine. Cockroach parts just destroyed the house. They are going to have to spend another almost 3 weeks cleaning up that house, sanitizing it, getting it ready for any new customer. And that can happen. Now, of course, collecting 3% per month against a covered call sounds great, but does it really help if the property value drops by 20%? That would take you 6-7 months to get back to break even, and of course 3% is on the high side of the time value that's available right now. So does a covered call generate monthly income or weekly? Absolutely. Does it cap your gains? Yes, it does. Does it insure against a drop? No. Standard covered call, we may generate 3% to the upside, but we've also capped the upside for further growth. We've recently seen the market as a whole move up as much as 7, 8, 10% in the last 15 days. Some securities have moved more. So generating 3% and capping the upside, you might get that 3% return, but you missed out on the rest. And the downside, if you're generating 3% against a stock you paid for, you're still risking 97% of what you would have in just buying the stock outright. Okay? Well, isn't that why stop orders exist? Well, stop orders exist to try to help us limit the loss on long stock, covered call positions. We can even set contingent orders and stop orders now on spreads, long calls, and things of that nature. But stop orders and trailing stops are just assumed insurance. They work only in normal market conditions. If your trigger is hit during the day, you get out of the stock, you get out of the covered call, maybe only take the 6 or 7% loss. It is really just a market order to tell your broker to close me out of this position anytime the stock is trading below this price. You have no control over pre or after market gaps. And as we head into earnings season, if you have a 10 or 15% decline in the stock and you had a 5% stop order, or maybe you had a trailing stop at a profit, when that falls and it gaps down below that price, you get filled at the 10% drop. Not where you had your stop order. You get filled for wherever the market is going. Quick question that just came up regarding spreads. Frank asks, if you do the direct opposite of a credit spread, which would be a deep in the money credit spread, will they both have the same probability of success? Yes, and the same risk-reward ratio. An in-the-money debit spread, just very quickly, so let's say that you and I are looking at a stock, Frank, that's trading at about $49. And we decide to sell a 52.5 call and maybe buy a 55 for the bear call credit spread. 2.5 point spread, maybe we generate 30 cents, so we've got about an 8-to-1 risk-reward ratio on the position. If you did an in-the-money bear put debit spread, which is a parity trade to the bear call, we might pay a debit of $2.20. And so if the stock remains below 52.5, we close out the position, get the 250 back, we make 30 cents, but our risk was 220. In both cases, the probability below that we're looking at is the same. The theoretical probability the stock would be below 52.5. The call that we sold for the bear call spread and the put that we sold for the bear put debit is exactly the same. Doesn't change the probability when you look at the same strikes. All right? So let's go back here to this discussion. Stock insurance versus renting out your stock. A covered call is not simply renting out your stock. There's much more involved that you have to pay attention to be successful in a covered call portfolio, and you're going to be missing out on the upside. But in the same comparison, a radioactive married put is not just stock insurance. There is much more to that which benefits the investor. All right, I just wanted to review that real quick. Take 5-10 minutes to review that, but let's really talk about why we're here today. The market has been on a good run. Here's the SPY chart for just the last month or so. I want to just get a better color here. Sorry about that. Let me get the pen going. There we go, folks. So we see after our big dip here on the 24th and into the 27th, we had that correction. since that correction, we've seen almost a 10% gain in the SPY, almost up to 220. It's getting close to it, but so let's call it about an 8%, 9% gain, which is pretty good for a 14-day time period. You know, if I had sold a weekly option against SPY and generated 3%, probably would have been called out here, sold another call and hoping to get called out on Friday as well. Might have worked out pretty well with the movement, but would have missed out, would have only gotten maybe, well actually SPY is less volatile and we know that, so it probably would have been only 4%, where of course owning it outright would have maybe given us closer to 8 or 9%, double what you can get with a covered call, right? But naturally, stocks in your portfolio probably went along for the ride. I've had one or two stocks that have been down as well, but most of my stocks have shown the same risk reward, or I should say the same graph, same candlestick graph that the SPY and the broad-based market indicators have shown over the past 15, 16 days or so. So where are we now? Most likely in our portfolio. Positions are up. If you've got bullish positions, they're probably up in price, even long calls perhaps. You have unrealized gains in your position. We've got expiration coming up in a day for standard expiration. Many of you might be trading weekly, so you might have another expiration coming up 5 or 6 days. And we're entering into earnings season. So now with our stocks up, what do? This is a big conundrum. It really is. It sounds great to be up, but what are we risking now? Well, we can do nothing and hope and pray. We can leave the position open, hope that the stock continues to move up as the market continues to move up, be a little bit speculative in that case. Maybe you can set a stop order or a trailing stop to try to lock in your gains. But if you've got earnings coming up, let's say in the next 10 or 15 days, and the stock gaps down 15 to 20% or more for poor earnings, you're going to get filled at a loss. That market order, that stop order is just going to trigger. You're going to get whatever the market is offering, not the price that you wanted to close out your position. Should you sell the stock now? Take your profits. It's always a conservative good idea, but then we forgo further upside. Earnings could be extremely positive, and you could see an additional 10 or 12% gain in your stock that you might miss out on. We sell half, reduce our cost basis by maybe 50%, not really locking in any gains, but hope that we don't realize a loss on the remaining 50% we have in the position. Or do we say, hey, now that the stock's up, let me sell a call to give myself maybe a little 2%, 3% protection as we head into earnings, which of course would cap our gains to the upside. If there was a positive earnings, we'd miss that boat, but we still might have a positive return. But all we protected to the downside again was that 2 or 3%. Didn't really protect any more than that. Here is one such stock. This is actually a trade in my account. We're going to look at my actual trade. We're going to look at what was possible, what is possible. We're going to take a look at potentially your stocks as well today to see how we can lock in gains, how we can generate income and leave the upside open and smile through earnings. But here's Boston Scientific, BSX. Over the same 14, 15-day period, it essentially mirrored SPY and SPX. We had that drop down on the 24th. On the 27th, the 28th, the stock was trading at around 22.25, right around the 28th. Today we're at about 23.75, 23.80, so we're looking at an unrealized gain of 6.7% on the BSX position. Earnings are coming up on July 28th, about 13 days from now. So what do? Do we sell now, taking the profit of 6.7%? Maybe fearing that the market's going to correct. We want to get out now and take our profits. Do we want to sell half, close out 50 of our shares? Let's say we bought 100 shares at 22.25 on June 28th. Sell half now, 50 of those shares. We'll get about $1,190 back at 23.70, 23.75. So we'd only have about $1,100 or so invested in the position. But if the stock falls 10, 20% or so from where it is now, it'd be back at $21, we may have a loss. Again, should I set the trailing stop now? Maybe at $23, maybe even at $23.50. Well, if it pulls back tomorrow, or if it pulls back on Monday, it drops back down to $22.50, $22.75, I'm going to get filled at $22.75, not the $23.50 or so that I wanted, whatever the market is, because that's just a market order telling my broker to close me out of the position. If the stock's at any time below $23.50, they give me what the market offers. I can't get the $23.50. And what about selling the call? We could sell an August maybe 24 strike call, slightly out of the money, generate 60 or 70 cents. Well, that only hedges the downside by 60 or 70 cents. We could still result in a loss if the stock falls. Oops, sorry, folks. So, what is our answer? What is one of the things that the radioactive trading techniques can help with this situation? Well, it allows us to stay in, and it allows us to satisfy all needs. With the radioactive trading techniques, we can lock in gains that suit our needs with realistic strike prices. That's important, and we're going to talk about that in just a moment. We can still generate income and leave the upside open. And there's also a way where we can set up a profit and loss chart that's a smile, that has no potential chance for risk going into the earnings or slightly after the earnings, and we can profit to the upside or to the downside as well. So we can have it all. Okay? We're going to show you now how you can lock in gains, keep the upside open, and generate income on your positions following the techniques that we use radioactively. We're also going to show you after that what is possible if you're already in a radioactive trade and we're sitting in the position we are now with the market up, as it has been the past 15 or 16 days. All right, so let's navigate out now over to power options. And we're going to take a look at Boston Scientific, and we're going to take a look at what's possible. One of the available tools that we have on power options under the married put and collar position is called the insurance tool. This simple tool allows us to put in our stock price, and then we can see what put options we could buy, or potentially even collars we could create to have no risk on the trade, still have unlimited upside, or do a combination of both and generating income as well. So as we saw back on that chart at around June 28th, we could have gotten into Boston Scientific at a price of $22.25 during the day, closed at $22.35. This was bouncing around all day. And I'm going to set the put expiration time frame. I'm going to buy a put to ensure the gains that we have on the stock and also give us control that we don't have with a stop order. But I'm going to leave all months because we want to talk about what works, what's realistic, and what doesn't. So let's just simply hit calculate. And now we get a brief description here for the current position. The stock is bouncing around, as I mentioned, 23.75 to 23.80 today. So we see we have an unrealized profit of 6.9%, almost 7%, or $1.53. The stock's currently trading at 23.80. Let's just call it that. Now, we could go short term. Remember, earnings are coming out on July 28th. So we could go short term, buy a deep in the money August 27 put for 3.30. And this would guarantee a profit of 145 or 5.7%. Well, that sounds fantastic, doesn't it? We're giving up only about 1.2% of the gain that we have, but will we still have unlimited upside profit potential? Absolutely. We did not cap our gains by doing this, but this is something, this 27 put, even though it has the highest locked-in profit for my current position on BSX, it is not a good choice. It's an unrealistic strike because the stock's only at 23. Yes, it does give me the highest locked-in profit, but are my expectations the stock's really going to go beyond 27 with the earnings coming up? I mean, we're almost talking about a 20% gain due to a positive earnings. Of course, anything's possible, but is it realistic? Let's take a look. We're going to go to the profit and loss chart, and here's our graph. Here's our setup of what we'd look like if we did buy the August 27 put today for 3.30. We are going to increase our cost basis to 25.55. We have a locked-in gain of 145. This is now a bulletproof position. We can't lose no matter what happens. The stock stays below 27. Anytime between now and August expiration, we're guaranteed to make 5.7%. Boston Scientific could drop to $2 per share, and we still have no chance for a loss on the position. Much better than a stop order. This is real insurance, and we own a secondary asset that we could still manipulate. However, this is not really a realistic position because I want to be able to take advantage of further upside if the stock gaps up, but a more potential target is probably a 10% increase, maybe an 8% increase on the stock. So we're maybe talking about a target price of 26 or 27. Here, or 26 or 26.50, here, this is only going to show us a 145 profit. That's not bad, but our goal for seeing more upside potential and having no risk to the downside is not satisfied. So going too short of a term and going too deep in the money is not a good target. Joe says, will we receive a copy? Yeah, Joe, I am recording this presentation. I'll have it posted for you today at radioactivetrading.com before 5 p.m. Eastern Time. All right, now let's go back to our listings. So we do have some other short-term puts here. We could buy the 25 put. It's only about $1.56 for August expiration, 36 days away. And that would lock us into a guaranteed 5% profit, and we're at a more realistic strike. Okay, so let's take a look quickly at that profit and loss chart and see if it satisfies our needs. Well, we've got a locked-in gain. If I expected the stock to move up, let's say to 26.50 after earnings on July 28th, so let's see what the system tells us would be our expected profit if Boston Scientific gapped up to 26.50 on the 29th. All right, so here we'd see we would have a loss of about $143, but we'd still have $425 in the stock for a gain of $282. That's much better than what we would have seen with the 27 put, where we still would have only been locked into a gain of $145. We almost doubled it, didn't we? So selecting a strike is a better target. Select a realistic strike, I should say, when you're looking to lock in your gains. Although that deep in the money put locked in more of our expected profit, the potential for realizing further profit is not there. So when I'm looking to lock in a gain, I want to pick a reasonable target price. And for me, the 25 might even be a little bit too much. But let's talk about something else here. One of the main core principles of radioactive trading is what's called the radioactive decay line, the time value decay. Most of you, in fact probably all of you, are options traders. And you know that when you're buying an option, say buying a call, maybe buying a straddle or strangle, if you buy too short of a time frame, you're going to realize a much faster time decay. You have a much higher probability of the option that you purchase going to zero and losing the time value, or at least the time value goes to zero. When we're buying an option, whether for speculation, as just buying a call or buying a put, entering a straddle or strangle, hoping for an earnings move one direction or the other, or buying a call or buying a put for insurance against a long stock or a short stock position, we know that buying further out gives us better advantage. When we sell premium, we want to sell week by week or month by month to get a higher annualized return. Well, the reverse is true when we're buying. We want to be buying farther out in time. We may pay more up front, but we're paying less per day. You're paying a lower annualized cost. Plus, if I buy an option that's out to November or out to January, not only will I be able to cross the earnings coming up on July 28th, but if there's no movement on the stock, I'll have insurance in place and likely a bulletproof position and cross the next earnings that'll come out in October as well. So let's take a look at January positions. We're just going to narrow this list down, and let's go to January, about 190 days out, close to 6 months out in time. Gives me a nice good time frame for the position. I'd be able to cross 2 earnings events, and the time value decay is not going to work against me, as we'd see the time value decay rapidly go to zero with the August option once we cross the July earnings event. Okay, so once again, we do see that we have some guaranteed locked-in profit with the 25 put, 26 put, and up to the 28 put. But again, it's not as high as what we saw with August. But it's because we're paying for that extra time to give us extra time premium. Remember, the August 27 put that we were looking at had a price of $3.30. And that was for just a 36-day trade. Here, I can have 190 days of protection at that same strike. I'm still not going to do it. I think the 27 strikes is unrealistic. However, The price is only $3.80. I'm only paying 50 cents more for an additional close to 150 to 160 days of insurance. This is the advantage of buying time. Both of these are deep in the money, so they're at least, that $3 worth of intrinsic value or close to it. Okay, $3.20. But this is only 50 cents more than what we paid for August. We're getting 150 extra days. All right, that's why we want to look further out in time to have a lower cost per day. But again, not all of these positions bulletproof us. When stock's at 23.78, we do see here we'd have a locked-in profit for the January 25 put of 1.3%. Not nearly as high as the 5% that we saw for August. But can we satisfy the other needs that we want? We want to lock in gains. We do want to generate some income, and we want to leave the upside open. Well, of course, that's a possibility as well using the radioactive trading techniques. Let's go ahead and take a look at the profit and loss chart for taking the January 25 strike put. We have a small locked-in profit. Okay, it's going to cost us $239 to buy one put contract. That does put our total cost for the stock and the put up to $24.64. However, we bought a 25 put for January, which we control. If the stock gaps down to $10 on July 28th, I'm not going to get stopped out. I have the choice now to close the position or to adjust the put option and stay in the position if I think the stock's going to recover. Buying the put gives us the right to force someone to buy our shares of stock from us at any time at $25. My total cost only went up to $24.64, so that means we have a guaranteed profit of $36 or only 1.5%. Okay, and the upside is still open. And because we bought the January put, when earnings come out on July 28th, whether the stock moves up, down, or sideways, we're not going to see a large time value collapse on our January option. It's going to retain most of that time value we just paid into on this position. So what do I mean by that? We're looking at $1.20 worth of time intrinsic value here. So roughly about $1.20 of time premium on this position. Okay? Now, let's do that same example we saw before. What would happen with our January put if the stock goes up to $26.50, theoretically, using the Black-Scholes pricing models, the day after earnings on July 29th? Well, looky there. The stock would increase, of course. We're going to gain another $2.70 or so. So a little bit more than 10%, of course, but let's say $26.50. We're going to move up about $2.70. We'd have a 425 gain in the stock, same we would have with the August put, either the 27 or the 25. But our put only declined by $132 because the time value decay did not affect us. Even though it's out of the money, it would still have $100, $110 worth of time value because it's a January option. So now the profit is a little bit more than the August 25 because of the expectation and the time value that would remain in the position. Not a lot more. Remember, we saw the profit there would have been $282 if the stock moved up to $26.50 and we had purchased the August 25 put. Here with the January 25 put, we're looking at a little bit higher profit. So we paid a little bit more, but we're going to get a little bit more back. The adage here is the insurance, you get what you pay for. I could buy a 20 strike put for August and pay only 20 or 30 cents, so I'm not adding much into the cost basis. But in order for the insurance to give me any benefit if the stock collapses, it would have to fall below 20. Now I'm already locked into a 10% loss. That's not insuring your position effectively either. You get what you pay for. And what we're illustrating here is that even though we paid more for that further out in time option, the decay is not going to work against us, and we've still insured our stock. Now, how do we satisfy the other needs? Can we still generate income, increase our locked-in profit, and at the same time leave the upside open? Absolutely. Many of you have seen in Kurt's other presentations, of course, where you've gotten the free white paper called The Sketch, income method number 1 was introduced to you. It's a very simple process. We do use covered calls, as much as I discussed earlier in the presentation, that the covered call is not a wealth option. But using covered calls to generate income selling a call against a stock and put combination to create a collar can be very effective, but it's not that effective as we're going into earnings. Boston Scientific does not offer weekly options, so to get any type of premium, naturally we're going to go out to August, 36 days away, and this will go through the earnings events coming up on July 28th. Well, since we bought the 25 strike put, and we do have insurance in place, I may at this time consider selling the 24 call. Generate about 65, 66 cents of premium. Okay, let's see what that looks like. In general, we never sell a call below the put strike price, but because we have some locked-in profit here, this might be able to work to our advantage. But let's take a look. So we're going to sell a call which obligates us to deliver shares of stock at 24. We do still keep a maximum risk and a bulletproof position, but it dropped to only 0.1% from the 1.5. Why? It dropped to the upside. The downside, insured protection increased. So we had a guaranteed profit of 36 cents initially. We just collected another 66 cents. So the guaranteed profit down below is going to be about $112 as we fall in price. That's true. But if the stock moves up, if we have that large gap and go to 26.50 because we sold the call below the put strike price, we're giving up $1 difference, and as the stock gaps up, we get no more positive delta on the position, and at the same time, we give up our stock at 24, and our cost base is only $23.98. And as the stock moves up, the put is just continuing to decline in value. We're not getting anything back. The combination we use at Radioactive Trading, the stock plus put, always has a positive delta to the upside. Once you sell that call, you lose that, and that's why we see this dip if the stock gaps up in price. So I'm not going to say that's a no-no, but this didn't satisfy our needs, did it? We did generate income. We did further lower the risk to the downside, but we're taking away a lot of profits to the upside. That's not solving our needs. Well, how about what can we do? What instrument can we use to realize more profit to the upside? If a stock gaps up, what's going to give us a profit? Well, buying a call. Okay, so combination here, if we sold the August 24 call for 66 cents, we may be able to complete what would be a bear call spread. But in the combination of the married put, it takes on no risk. I do not have to cover the margin of the difference in the strike prices because my broker just sees this as a covered call with an extra long call. And I'm only going to pay about 12 cents for this position. Bid of 10 cents, ask of 14. We're going to go 2 strikes apart to the 26. So let's put in a midpoint of 12 cents to buy the August 26 call, which will still take us through earnings. And now we have a slightly better risk-reward profile in the sense that we have a guaranteed profit now of $90 or 3.7%. And that's about the worst case scenario if the stock happens to be trading right at 26. But as we can see, if our expectation was the stock was going to go to 26.50, well, in this case, we didn't really get as much profit as we would with just the married put by itself. Okay, and part of the reason why we're seeing that is because the strike price is wrong. Right? Selling that call below the put, even though we were bulletproofed, is not the best answer. But are we back in a no-risk position? Absolutely. What happens if the stock collapses? Well, even if it drops to 20, you're guaranteed a profit of $101, more than we just had with the put. We could realize about $200 of profit if the stock stays the same. If the earnings have no effect and it bounces around 24, and at 26, we still have a profit of 104, and if it does gap up and exceed our expectations, we still have unlimited upside. This is not the graph that I would like. Okay, and right now, selling, let's go back to the locked-in profit of $36 at 1.5%. I'd get a better risk-reward profile selling the 25 and maybe buying the 27 in this combination, keeping the call that I'm selling equal to or above the put strike price. However, I don't think there's enough premium there to satisfy my needs. We're looking at maybe, let's just take a look. We're going to sell this for about 28 cents, and I'd buy the 27 for probably about 6 cents or 7 cents, or so probably 7 cents, okay? So let's put in 28 and 7. So it's only 21 cents. It's not enough premium for me. Even though I'm bulletproof and this will increase my bulletproof status, this doesn't look like a good combination. But let's take a look. We will get a better risk-reward profile. We won't get as much locked-in profit, but now if the stock's at 25, we'll have that profit of 213. Stock's trading at 27 will still have a profit of 139, and it'll continue up. Doing income method number 6, the bear call spread against your protected position, allows you to generate income, but still leaves the upside open in case of a large gap. So it solves the problem of the covered call and income method number 1, just selling the call against it, because I want to leave my upside open going into earnings. By the way, a different combination we could consider might not give it, we saw it earlier, but let's take a look. I'm going to go back here to the insurance tool very quickly. We're going to take a look at our January put options again. Here's that 24 put one more time, but it doesn't guarantee a profit. We have a locked-in profit of negative 0.5%. Okay, so that means we still have a risk of 0.5% with the current prices. So we still have a small risk on the position if we purchase the January 24 put at 187. Okay, but now if I chose this put, I'm going to get a better risk-reward profile doing the same income method number 6 we just considered, selling the at, slightly out of the money call, and buying one further for a credit. And again, we're going to keep that same credit. I'm going to sell this call for 66 cents, buy the 26 for 12 cents, so we're going to get that 54-cent net credit. So we're going to sell this one and buy the other. Now our locked-in profit is a little bit better. It's only 1.8%. But this risk-reward profile, we're not giving up as much. If the stock's at 26, we'd have about $125 profit. We go further, and we have this locked-in risk as well. Guaranteed profit now of $42 or 1.8%. Okay, so that's the decision-making process that we like to go through. And this might not be the best example because the premiums are small, but percentage-wise, they're having a great effect on our position. So based on your expectations going forward and following the rules in the blueprint, what I'm analyzing here with comparing the 24 put to the 25 put and going further out in time is the same reason that the 3 core principles exist when we're opening a new married put trade. When we look to open a stock plus put combination, we want to go at least 150 days out in time. We want to go slightly in the money, but we want to be less than about 15 or 20% in the money. Okay? Buying at the money means we're paying into the highest time premium. This 24 put, even though it gives us a good risk and almost locks in our profits, we have no fear going through earnings whatsoever, and we still have the potential to generate income and leave the upside open, it looked like the 25 actually gave me a little bit better bang for the buck if the stock collapses or even if the stock moved up to 26.50. So that's what we're comparing, is that we wanted to go at least 150 days out in time because the time value decay won't affect us as much. We could actually cross 2 earnings and still have a bulletproof position and do other adjustments in between. Now, I don't want to go too deep in the money. We saw that with the 27 put. When we looked at the August 27 put or the January 28 put, that's too deep in the money. Sure, we'd have a higher locked-in profit, but our expectancy for further profit is getting closer to 0. We've hedged ourselves out too much by going too deep in the money. So going in the money is a little bit better than at the money because you're paying less time premium, you're locking in more intrinsic, but going too deep in the money can basically push you out of a trade and a reasonable expectation for any further profit as well. Okay, and of course, following that, we want to go at least 150 days at a time. We want to keep our risk and our position size to single digits. We're already accomplishing that because we're essentially bulletproofing the trade. We're locking in our gain, and again, because we purchased the put, it is a guaranteed locked-in gain. If Boston Scientific does drop to about $20 per share after earnings, goes down by about 15% or more, almost close to 20% decline, if we had the stop order in place, we'd get filled at 20 and we'd have a loss. Having the put in place, I can choose to exit at that time and only have a profit of 1.8%. That's the worst case scenario. Or I can decide to stay in the position And if I feel the stock's going to recover and it's an overreaction, I've still got the put in place and it's still 190 days out. I control that choice, not my broker, not that market order, which is just a stop order, is what a stop order is. I'm in control. Oh, and by the way, having this doesn't mean that I'm just locked into this profit and I just have to wait to January. The put is an asset. It's a second asset as well as the stock. So now I can decide, well, if the stock's down at 20, this put's going to be worth probably about $5, $5.50. I can sell that put, reduce my cost basis, and maybe roll down to lower strike and still have a guaranteed profit, but be able to do better income methods going forward as the stock recovers based on my expectations. But the key is that I control that thought. The market doesn't control it for me. My broker doesn't control it for me. I decide what I have to do next. And I don't even have to do anything. I can wait a week or two and see how Boston Scientific recover after that massive decline and disappointment, and then decide to make a choice of how to adjust the put, close the position, or move on going forward. All right. So those are some of the possibilities. Using income method number one, you could generate income now that you've locked in your gains on your stock. But if you want to leave the upside open, one of the other 12 income methods is income method number 6, where we can generate income. Here's about 50 cents, but we can still leave the upside open. So is this realistic? Absolutely. These are all real numbers. Did I cherry pick the bottom by showing a stock that has on June 28th was at its low price of $22.25? You can say that I did. But I also did that because I knew where the stock was at that time, because this is an actual trade that I'm in, not these exact numbers, but an actual married put that our Fusion subscribers at Radioactive Trading have been following for about the past 50 days. And we're going to take a look at what we could do now on that position as well. I promised you something else in this webinar. We showed already how easily you can use the tools on power options and concepts of radioactive trading to more effectively lock in the gains on a stock that's moved up in price. I showed you how you could generate income using one of our income methods and leave the upside open, much better than simply selling a call. That was income method number 6, the bear call spread. We talked about married put I could have gotten into, by the way. I'm going to show that very quickly. A married put we could have gotten into on June 28th, instead of if I just bought the stock and it's up now and I'm looking to protect it, I could have bought Boston Scientific at around $22.25 on June 28th, and at that time, I would have bought the January 24 put for about $2.75. All right, let's take a look at that. Let's see where we are. Instead of just buying the stock and having an unrealized gain, let's talk about what a married put would look like if we opened it on June 28th. Well, here's a position that gives us a nice manageable risk of 4%. For at the time, it would have been about 205 days of trading. Now the stock was at $22.25. We bought the 24 put, or could have bought the 24 put, for $2.75 on June 28th. Now, when we bought the put, if we had bought this put, we were $1.75 in the money. We're guaranteed to get that back. $1.75 of the $2.75 we paid out, we're guaranteed to get back. At any time between now and January expiration, I can force someone to buy my shares of stock at 24. My cost in was only $22.25. So my risk is the time value, that $1 time premium that remained of the $2.75 I paid minus the intrinsic value. Okay, so that's my risk. Why is this important? Well, where are we now? The stock's at $23.81. Let's call it $23.80. The position is up, the stock, I'm sorry, is up $1.55 from where we got in. Where's my put? Did it decline? Absolutely it declined. Okay, it's going to move down as the stock moves up. Let's take a look. Where are we now? The January 24 put. Bid of 178, ask of 187. So let's say that we could get maybe 182. Okay? Well, the stock's at 23.81. My put's at 182. This put is essentially 20 cents in the money, isn't it? So what does that mean? That means this put option that originally only had $1 of extrinsic value or time value now has $1.62 of time premium or extrinsic value. When the put option, this is one of the three core principles, the at-the-money bell curve, okay? Well, at-the-money bell, well, let's do a better bell curve than that. There we go. The at-the-money bell curve dictates when we're buying options, we want to buy in the money, or we want to buy out of the money to pay the lowest time premium. When we're selling, we want to sell at the high. We want to sell at the money to get the best time premium. What we just showed was selling the August 24 call. It has the best time value available, okay? But now that my put went from in the money when it only had $1 worth of time premium, and the last 16 days as the stock moves up, my put has dropped, but the extrinsic value, the time value, which is our true profit as options traders, has swelled because it's now at the money. We have gained 62 cents in time premium. That sounds strange as time passed. That's why we typically use the term extrinsic value. But that's the advantage of the at-the-money bell curve. We bought in the money, and as the stock moved up, our option became at the money, and the time value swells. What does that mean? We can use that. Some of the other income methods I'm not actually going to show right now, but we could use income method number 4 to move the put up and potentially bulletproof the trade. I could move this put closer in. I could sell my January and buy a closer in put for lower time premium and take care of that 62 cents, drop my risk almost down to 35 cents or so on the position. And then guess what? I could still do that income method number 6 to generate income. But one of the things I promised you is a smile through earnings. Okay? Now, as the stock moved up, of course, one thing we could do is roll the put. But a recent transaction that recent transaction this Curtis showed you for the past few months, the newest income method number 12. Well, this put is actually cheaper than it was before. I could manipulate this put, but as we know going into earnings, what do we like to see? We don't know what's going to happen next, do we? Not at all. I don't know what's going to happen next. Come earnings July 28th, the stock could gap down or the stock could move up. So I want a position that puts me in place to profit on the upside or potentially to the downside as well. And all of that can be combined with other income methods. So what would an income method number 12 look like? Well, with the stock at 23.81, right now I might be able to buy the 24 put again, buy a second contract. Let's look at the 25 again. We have the 24 put in place. I'm not going to manipulate it. I'm not going to generate income yet. But I might buy the 25 put here. This is going to cost more money, of course. We're going to put in, what did I say, about 235, let's call it, for the put. So I'm going to increase my cost basis into the position. Does my risk increase? Absolutely. It moved up to 8.6%. How is this doing anything I promised about smiling through earnings? Remember, that is the worst case scenario, meaning I hold this new three-legged position, stock, January 24 put and 25 put, all the way to January expiration 190 days from now, and I choose to make no adjustments in the near term. That is the worst case scenario. I did increase my risk. However, as we approach earnings, the day after earnings, what would our profit and loss chart look like even if the stock stays at the same price? Let's redraw that. Let me take off the expiration. What do I have? Because we're not going to lose the time value on our puts, which we already saw, because we're using the January puts following the rules, the radioactive trading, and they're discussed in the blueprint, I now have a position where even if the stock stays the same, profit to the downside, can profit as the stock falls further and further. If it does gap down to 20, we'd have a profit. And if the stock moves up, we can have a higher profit as well. So now we've put ourselves into essentially a synthetic strangle. But because we're using the farther out put options, by the way, we're not going to see that time value collapse. We may see some implied volatility or volatility correction, but it's likely that we would not even see a loss. Even if it stagnated at the same time, we'd still have no risk on the trade, and if it gaps down, we can profit to the downside, and we can profit to the upside. We've made a smile. I can go through earnings now on the Boston Scientific position with absolutely no fear, no concern, knowing that I can profit to the down or the upside. And by the way, that's not necessarily even the end of the trade. We hit earnings on July 28th. The stock, let's say, gaps down to 24, or I'm sorry, gaps down to 22. Okay, what just gained? Both my puts. I could sell to close the 25 put for a profit. It's going to be worth at least $3, but with a time value, it might be even worth $4 or $4.50. So I can take that off, lower my cost basis more, and I'll be a better position still holding the 24 put. What happens if it gaps up? We already saw that. Both puts would decrease, but I'd still have $1 worth of time value, almost $1.10. We saw that when we ran the calculated expected profit and loss chart. If Boston Scientific went up to 26.50, that target price to the upside, well, this would still be worth $1.10. So I could leave the 25 put open, sell to close this to lower my cost basis back down again, probably be in a bulletproof position, and with a stock at 26, I could manipulate my other asset, not just insurance, it's another asset where the time value is working in my favor. By the way, what would have happened if the stock did go up to 26? My in-the-money put that I just purchased at 25 for $235 would now be at the money, so I'd lose intrinsic, but that time value would swell just as we saw with the 24 put, and we could manipulate that in other ways as well. And since I have the January puts, guess what? I can continue to trade income, continue to further bulletproof the position after that point, and have an even better locked-in profit going into October expiration, all the time continuing to generate income and applying the other 12 income methods that are still in the blueprint. So here's me smiling, going through earnings in July 28th with no fear, ability to still trade other income methods as well. We could put the income method number 6 on top of this if we wanted to, but again, as I showed, I don't think the net credit there is going to give us what we want if we tried to force going to the 25 and 27 strike on the position. Okay, so that's what would have been possible had we opened the married put on June 28th. So we showed you how you can lock in gains on stocks that are up already, a better way to do it than a stop order, a better way to generate income than selling a call, and to go through earnings without any fear. This is a manipulation that's possible if we had entered the married put on June 28th, buying the stock at $22.25, January 24 put would have cost us $2.75. What about the real position? What do I mean by real position? The real trade I'm actually in on Boston Scientific that our Fusion subscribers at Radioactive Trading are following. On May 16th, I got into Boston Scientific at $22.75. This is an actual trade in my Fidelity account. This is an actual trade that we posted to our subscribers at Fusion. January 24 put at $2.62. A little bit different risk-reward profile, but this is a real trade. We have an unrealized gain on the stock of about a little bit more than 6%, and the position right now could be liquidated for a gain of 3%. Or, remember, I bought this put at $2.62. At the time, it had a time value of $137, but just as existed with the January 24 put we already looked at, my time value now is about $1.60, so I have a gain in time value. Can I get the same effect doing the income method number 12 here by buying the 25 put for Boston Scientific? Absolutely. We said this was at $235. I'm going to put it there at that price. Let's go ahead and submit it. All right, so the max risk again, the worst case scenario, if I held it January expiration and did nothing, would have increased. But what about if the stock stays at the same price even the day after earnings? Not as much, but a no-risk trade and the potential for upside profit if the stock gaps up or if the stock gaps down. And these assets are at 190 days, so I'm not going to have that time value loss that I would have, or the volatility crush that I'd have if I tried to go cheap and buy the August options that are only 36 days away, which really aren't that cheap when you think about it. Going into August, that's going to have the most effect for an implied volatility crush, and you're going to see that time value dissipate as rapidly as possible. You get what you pay for, and this puts us in a position where we can have no risk and still realize further upside profit potential and further downside profit potential as well, and the ability to still apply other income methods to the position. All right. So that's what we wanted to kind of share with you today. And let's review just what I shared with you. What did we learn today? Well, today I showed you how you can easily lock in gains effectively on stocks you have up in price instead of using a stop order, which is assumed insurance, instead of just selling a call, which will only hedge your position by 1 or 2%, maybe 3% at best, and your upside would be capped. I showed you a lot. I showed you income method number 1, the effect of just selling a call against the position once you've insured it. We showed income method number 6, how you can generate income and leave your upside open. We also just showed you an income method number 12 position, but there's much more to the entire story. The blueprint is the only place where we discuss all 12 of the income methods that are used against the protective setup. We showed today how you could lock in gains from a stock that's already up. We showed you the potential of how you could have manipulated the position if you started controlling your risk the proper way up front using the radioactive trading techniques and what's taught in the blueprint. And we showed you an actual trade that is real life and real time and shown to our real subscribers at Fusion. So the blueprint's the only place where you can get all 12 income methods. There are some income methods I could use which actually would be better than what we saw with income method number 6 today, and potentially even better than what we saw with income method number 12. The only place to get that is in the blueprint. There are 5 special bonus offers that you receive if you pick up the blueprint. Go to radioactivetrading.com/iridium to take advantage of the special offer we're running right now. I'll send that link to everyone as well, right here. Let's see if I spelled that right. There we go. So it's radioactivetrading.com/iridium. You'll be able to take advantage of the 5 special bonus offers we're running right now. You can get the quick action guide that Kurt put together, which is a $50 value. We'll give you the first of the 6 Mastery Series CDs that Kurt put together for free. That's an $89 value. That'll be included in your blueprint. The first month of the Fusion subscription, where you can follow my trades, Ernie's trades, and Greg's trades, and look at all the track records from Kurt, Ernie, myself, and Greg. You can get your first month for $10. I'm sorry, that's a $59 benefit. It's usually $69 per month. The new blueprint owners get your first month of Fusion for $10. And we'll give you a free month of power options, so you can use that insurance tool we showed today. You can use that profit and loss chart. You can start tracking your positions with power options portfolio tools. Very important as we head into earnings. We just had a session on that yesterday as well. And of course, you'll also get a free coaching session, free 1-hour, 50-minute coaching session with myself or Ernie, where we'll walk you through the tools, the concepts of radioactive trading, and answer any questions that you have as well. That's a special offer we're running for the blueprint right now. So you can go ahead and start a free trial to power options if you want to just play around with the insurance tool to see your stocks and what profit you could lock in right now. Just go to powerup.com/RAT. All you have to do is put in your name and email address, and you'll get a 2-week free trial to power options. But the only place where you'll be able to see the full setup, the full discussion of why we choose the strike price and what strike price is the best one, whether you're opening a new position to have the proper insurance in place, rather than a stop order or trying to hedge it with a covered call, is going to be in the blueprint. Okay? So of course, you can test out the tools there for 2 weeks. Just go to powerup.com/rat, but you really want to consider picking up the blueprint there, taking advantage of those 5 special bonus offers we have, and start trading correctly with the insurance in place. But remember, it's not just stock insurance. It's a second asset that is working in your favor. Whether the stock moves up or down from when you open the position, you're going to be able to manipulate the gain in the put or the increase in time value to cancel that risk and lower your cost basis as well. Now, if you think of any questions at any time, of course, you can send us an email to support@radioactivetrading.com. Remember, you can also call us during market hours at 302-992-7971. All right, ladies and gentlemen, well, that's all I had for you today. I want to thank you for joining me. A nice quick presentation, and a nice quick presentation with actionable trading ideas that you can use right now. Okay, whether you pick up the blueprint or not, if you go to Power Options, you start that trial. You can go ahead and plug in your stock symbol. You can plug in your cost basis. You can see which puts can lock you in to guaranteed profits heading into earnings season, or where you could potentially have a smile set up for yourself going into earnings as well. All right, let's see here. Well, Frank says, just selling covered calls, what's the longest time a person can hold the stock? Well, I don't know, if you get called away, you're going to be out of the stock because you capped the gain, Frank. You can continue to roll calls against it, but if the stock's moved up as they have, I mean, that's an interesting point. We talked about this on SPY. We saw over that June 28th to today, sorry, June 28th to July 14th period, how SPX moved up from about 198 up to about 218 or so, okay, or 217. Now here's the trade-off. Had you opened SPY as a covered call position, you might have bought the shares at 198 and maybe sold a 200 call a week or 2 weeks out in time for only about a 1% yield. But the stock blew through that. The ETF blew through that. So now you would have had to pay more money to roll the call to a higher strike, and then it blew through that again. So you can keep rolling the call and stay in as long as you want if you're just selling covered calls, Frank, but you would have missed out on all that upside. So even though you generated 1% the first week and maybe 1% the second week, the ETF that you bought's up 8%. And you would have had to pay more to buy back that call to avoid assignment if you wanted further upside. So you're probably actually only looking at a return of 3%, even though the stock's up about 8 or 9. That's the downfall of a capped gain. It's not, covered calls is not a wealth option. You miss on the upside going forward, and you're still taking on 97% of the risk to the downside as well. That's the trade-off as well. All right. Okay, so Fred said, so the 66 cents from the short call is the income. Do you buy back your short calls? Oh, yeah, in the blueprint it talks about if I had entered income method number 1 on that position, which I wouldn't do going into earnings, Fred. I'm not going to do that. I don't care if it gives me the most premium right now I could generate by selling calls and manipulating the positions. I'm not going to just sell the call for 66 cents because it caps my upside. The stock could jump 10% in either direction. Yeah, if it dropped down, that'd be great, but if it gapped up, I'd miss the upside. So yeah, the 66 cents, it would be income, but then I'd probably use income method number 6. What would I do with income method number 6 or income method number 1 if the stock gapped up above the 24 call? Well, that's what's talked about in the blueprint, not just the decision-making process and the setup for each of the 12 income methods, but how to manage them once you enter those positions as well. What adjustment would we make? Could we roll the call? Could we buy it back? Could we flip the income method number 6 into another income method going forward? Those are all possibilities, and that's what's talked about in the blueprint. Fred says the longest I had was 12 months on 2 different stocks. Okay, well, this is an important point. So I don't know what stocks you bought, Frank. Okay, I don't know what the prices were for those stocks that you bought that you were in for 12 months. But let me ask you this. Over that 12-month time frame, did you generate enough premium to pay for the stock to where you had no risk? The Boston Scientific position right now, I've been in for about 55 days. I could make one adjustment today on that married put position that's in my actual account and have no risk. Have a guaranteed profit to the downside, still have potential unlimited upside, and that was done in a 55-day time period. But even after selling calls against the stock for 12 months, did you pay off the entire price of the stock? Well, unless you bought a $10 stock that was highly volatile and you were collecting close to 80 cents or $1 premium for selling at the money call, I highly, highly doubt it. Okay, so Fred asked the Fusion portion, can we subscribe to that and follow your trades? You can. Absolutely. You can go to radioactivetrading.com, Fred. Let me just do that real quick while I'm here. Of course. Let's see. Oops. Sorry, folks. Give me 1 second. There we go. Sorry, folks. All right, there we go. My apologies. So here at radioactivetrading.com, you can click on the Products tab. You see the offer for the Blueprint and the Home Study Kit, which contains the Blueprint and those 6 Mastery Series CDs that Kurt put together for you. And then right here at radioactivetrading.com under the Products tab, Fred, you can subscribe to Fusion. It's $69 per month. So if you just subscribe to Fusion without the Blueprint, you won't get that special first month of Fusion for only $10. What you'll also be missing is, of course, some of the lingo. Right? A lot of the trades that we enter, a lot that Ernie and I enter, or Greg enter, and you know, a lot of the terminology that's used here for some of the other tools, I'll talk about that in just a second, is sort of based on is based on owning the Blueprint. The discussion of the income methods, we don't describe anew each new income method when we open it. you can see what it is from the description of the trades that we post. We make adjustments to our position, but you won't have the terminology down. Okay, so that's what you're missing if you just subscribe to Fusion and don't pick up the blueprint. But if you feel you want to test it out, you want to see some of the positions we're doing, you want to shop around a little bit, that's perfectly fine. You can go right to the products tab and you could go right to the Fusion subscription there, and it's $69 per month. What you get access to is, number one, there's a variety of different lessons that Kurt put together that'll come out to you on a timed basis to help you get more familiar with the education in the blueprint. You'll be able to follow our trades, as I mentioned. You'll also be able to look at the track record. You'll have access to an RPM report, and what this is a basic search tool that you can adjust, but it is going to show you the exact positions following the radioactive trading criteria that we discussed in the blueprint, so that you can go ahead there and further see positions that we would enter, and 95% of the positions that we enter in Fusion are from the RPM report. The stock insurance tool, we threw that on there as well. So if you subscribe to Fusion, Fred, you'll be able to use that stock insurance tool just as we saw at Power Options. And then, of course, there's a variety of members-only webinars for Fusion subscribers where we show a little bit more detail on the different income methods and so forth. Frank says he was in ACQ for that 12-month period. It was down straight for 12 months and it made 10%. That's great. That's perfectly great. I have a position in Fusion, one of the track records, my closed positions from a few months ago, that was down 65% from where I got into it, and I made a profit of 4% using the radioactive trading techniques. Sometimes here at Radioactive Trading we like to brag about our losers because I could have lost a lot more. Okay, and here's an important question from Fred. Fred, you'll be able to look at that if you go ahead and take a look. I'm sorry, if you go into some of the product discussion or the resources discussion, and you can look at the track records too. I'm sorry, the question that came in from Fred is how many trades a month roughly? It varies, okay, and here's a trick, Fred. You're wanting to see if this technique works, which is why you want to subscribe to Fusion. You want to see if we're making money with this. I get that. There's nothing wrong with that. It's a very smart decision, okay? But, and I told you, of course, earlier that this is the most consistent strategy I've seen to make money long term, which is why I'm still trading at 50 to 60% of my account. But the trades per month, you might see as many as 10 adjustments per month, 5 or 10 adjustments per month between myself, Ernie, and Greg. You might see 2 to 3 new trades per month or more, depending on the market conditions. But I can't give you a direct number, and the reason why is because we don't treat this as an advisory newsletter service. Okay, the Fusion subscription, the trades that we're posting are more designed for new blueprint owners and new members of radioactive trading like yourself that are interested in the technique to see how we trade this in our personal accounts. We don't feel pressure to open a new position once a week as an advisory service that usually ends up losing money, okay? We don't force ourselves where we have to do an adjustment for everyone every 10 days or every 12 days one way or the other. We don't feel that pressure. These are actual trades. All of the positions that are in the Mike C portfolio, Mike C at Power Out portfolio for Fusion subscribers are real trades in my personal account, and I trade them that way, not with the pressure of feeling I have to open a new position every 5 days or make an adjustment every 6 days, for example, as well. But on average, I'd say you probably see at least maybe 5 to 10 adjustments per month on the open positions and probably 2 to 3 new positions per month as well. But at any time as a Fusion subscriber, you could go into the RPM report and pick a new trade, and that's the same list we would most likely pick from. And Jack asked, do you need Power Options to subscribe to Fusion? No, they're two actually separate services. Main kind of path of a radioactive investor is they will pick up the blueprint or the home study kit. They'll wait a little bit to digest the material. They'll start their first month of Fusion, maybe a month or so, or maybe 3 weeks after they picked up the blueprint or had it delivered to them, and they'll start their free month of Power Options. Or they'll wait and start Fusion first with a $10 discount, maybe do Fusion for 2 or 3 months, and once they feel that they've more mastered the techniques and what we're doing, they'll graduate, for lack of a better term, over to Power Options, which are tools designed more for self-directed options investors. But now that you have the knowledge and now that you have the skills down pat, after following Fusion, getting some more detail, watching how we trade it, going through the lessons Kurt put together in the members-only webinars, you'd be able to graduate up to Power Options and trade the married put technique on the stocks that matched your risk-reward tolerance and apply the income methods using the portfolio tools and the profit and loss chart we saw today. So you don't need power options to subscribe to FusionJack, okay? But again, just subscribing to Fusion, you'll be able to see the trades, you'll have some of the tools, but you'll be missing out on the lingo, and you'll be missing out on some of the other opportunities of the full education that's available in the blueprint as well. All right, ladies and gentlemen, 10 minutes after the hour. I don't see any other questions coming in. Once again, thank you all for joining me today. Happy trading, and we'll be back next week, probably Tuesday at 12 noon Eastern Time. I think I might do some trade comparisons there, discussing why we use the married put compared against doing other strategies that you might consider are very similar or would limit the risk as well. So look for that coming out on Tuesday at 12 noon Eastern Time. We'll do some trade comparisons there and strategy entry. Well, take care, everyone. Have a happy trading week. Have a happy expiration tomorrow. And we'll see you soon. Good night.